Good morning. Welcome to the University of Nebraska's discussion on proposed retirement plan enhancements. My name is Bruce Curran from Human Resources, and we're so glad that you're with us this morning and able to join us either in person or also by viewing this recorded presentation on the nebraska.edu website. Any questions or comments can be directed to benefits@nebraska.edu. If you'd like to ask a question at the end of this presentation, please do so in the Q&A section of your Zoom screen. Next screen, please. The focus of these enhancements are to create savings for NU employees. Modernizing our retirement plan will create a streamlined lineup of investment options while at the same time increasing options for those employees who wish to use additional investment products. Our goal is to have the best retirement plan possible for NU employees. Slide, please. First, it's important to say that your contributions and the university contributions will be staying the same. So there's no changes there. You will continue to be 100% vested, which means when you have access to your money and the university's money. So no change there. And TIA and Fidelity will remain our two main retirement vendors. So there's no change there. Slide, please. What is changing is how you pay TIA and or Fidelity to keep track of your investments. These fees will be more transparent and a fixed amount. And we'll talk more about that later in this presentation. Our core investment options will be streamlined with low cost and diversified options. A service called a brokerage window will allow thousands of investment options if an employee wants more choice. And the effective date of these changes is targeted for November 1st, 2022. Slide, please. The University of Nebraska is enhancing our retirement program after a thoughtful review by a university-wide committee and an outside consultant reviewed our retirement plan. Current projected savings are approximately $11 million per year to employees. This means over $400 per year to each participant. The university sees no savings from these changes. 100% of these savings are going to employees. Through the consultant, the committee was able to secure lower fees for record keeping and low cost investment options. Slide, please. These were the members on the university-wide committee. Slide, please. As noted earlier, 100% of savings will be received by employees. The university receives nothing. Over a 10-year period, savings to employees will exceed $110 million. Next slide, please. This slide shows that NU's retirement plan has some size to it, with over 27,000 participants, which includes active and retired employees. While every participant has individual needs for investing, the retirement committee and consultant believe this proposed plan offers the best options for both active and retired employees. Slide, please. Also, it's important to note that we are not alone in these enhancements. Several other universities have done the same thing and are doing the same thing right now, and we are doing exactly what they also are in their retirement programs. We sought their counsel as we prepared our enhancements. And now Brian Schlichting, Assistant Vice President and Director of Benefits, will talk more about the details of our enhancements. Brian?
Thank you, Bruce. Good morning, everyone. Thank you very much for joining us today. I'm going to spend just a few moments talking about our record-keeping fee structure that'll start on November 1st. From the beginning here, I want to be clear that this is not a new fee, but one you were likely not aware of in the past. I'll talk about that more in a little bit here. Under our new plan design, we'll be transitioning to a simple and transparent fixed dollar per head record keeping fee. That's regardless of how many accounts you have. So if you have a 401A account, a 403B, or a 457B account, you will only pay the fee once. At Fidelity, that fee will be $29 per year. At TIA, that fee will be $38 per year. If you invest your retirement assets with both Fidelity and TIA, you will have to pay both of them. So your total record keeping fee will be $67 per year. Next slide, please. So consequently, if you don't want to pay record keeping fees at both TIA and Fidelity, you may want to transfer your investments to one vendor. The next speaker is going to discuss the investment menu, but just to preview that discussion a little bit, it's mostly going to be a harmonized menu at both TIA and Fidelity, so it might make sense to consolidate to one vendor. To accomplish this consolidation, you contact the vendor you want to transfer the assets to, and they'll get you started on the process. So if you want to transfer your assets to Fidelity, you contact Fidelity. If you want to transfer your assets to TIA, you contact TIA. And both those numbers are on this slide here, and they're also available on our benefits website. You will also need to change your current and going forward contributions so they're only sent to one vendor and no longer split between the two vendors. So to change your current contributions, you'll need to contact your campus benefit office, and they'll assist you in that process. So to review, it's a two-step process. One, you change your vendor for your current investment holdings by contacting either TIA or Fidelity. And two, you change your current and future contribution allocations by contacting your campus benefits office. Next slide, please. Like I mentioned in my opening, this is not a new fee for our retirement plan, but one you were likely not aware of in the past. The existing plan design collected fees exclusively through what is called expense ratios. Those expense ratios included both investment management and record keeping fees. It was difficult to decipher how much was the investment management fee and how much was the record keeping fee. Those fees also varied based on your investment elections and your balances. So this new plan will charge a modest fixed dollar per head record keeping fee and is paired with low investment fees in our plan. So the table at the bottom of this slide demonstrates the savings of the fee structure. This uses target date funds as an example, which charge about 50 basis points in our current plan. So no matter your status and balance, we anticipate savings from this new structure. Next slide, please. My final slide kind of takes a step back and explains why record keeping fees exist in the retirement plan. In general, the record keeping fees pay for the services at Fidelity and TIA to administer our retirement plan. The record keeping fees pays for items such as your on-campus retirement reps from TIA and Fidelity. So when you meet with a TIA or Fidelity representative to discuss your retirement goals and investment strategies, it pays for those services of that representative. It also pays for the core administrative services that are necessary to administer a retirement plan. Those functions include the following: enrollments, distributions, buying, selling, and holding of retirement investments, the websites and participant portals that TIA and Fidelity offer our employees and retirees, the phone support from TIA and Fidelity, education materials that are also provided by TIA and Fidelity, and finally, statement and tax documents that are provided by TIA and Fidelity. So now I'm going to hand the presentation over to Dr. Brian Baugh, who's a member of our committee and an assistant professor of finance at UNL. And Brian's going to walk us through the investment menu. So Brian, take it away.
Great, thank you. Next slide, please. All right, it is my pleasure to introduce this new streamlined menu to you all. And as you can see, the foundation of this new menu going forward is a streamlined menu of Vanguard mutual funds, the most important of which is this first one called a target date fund. And I'll speak more to that on the next slide. In addition to that, we'll have a few index funds that we can choose from. These are diversified, low-cost investments that offer broad coverage for a given asset class, like US stocks, international stocks, and US bonds. Additionally, we'll offer a money market fund. And as Bruce alluded to, a new feature that we're introducing going forward is this brokerage window or brokerage account. And if you are a savvy investor, you've probably heard of a brokerage account before that you would do on your own, and it would be a taxable account. And in that taxable account, you'd be able to access individual securities or stocks. This brokerage account that we're referring to is different in that you get all the tax advantages as you currently enjoy in your existing retirement accounts. But the distinction is that you gain access to essentially the universe of mutual funds. And I guess the other important distinction is you can't trade individual stocks in this new brokerage window, but rather any mutual fund of your choice. And to give you an idea for how expansive this set of choices is, at Fidelity, for example, I think it's on the order of 8,000 mutual funds you can trade. The vast majority, well, several thousand of those are available to trade without any transaction costs. For example, the universe of Fidelity mutual funds are tradable within the Fidelity brokerage window for no transaction fee. Okay, so where else do the two vendors differ in their mutual fund, in their menu offerings? At TIA is where you will gain access to the TIA traditional annuity that is a very popular product among our employees. Next slide, please. And I alluded to the importance of these target date funds in the previous slide. And when we benchmark, for example, Harvard's retirement plan versus our proposed plan, it's nearly identical. And one interesting thing that pops out when we look at peer institutions is that about 70% of assets outside of annuities end up flowing to these target date funds. So they are a huge, they're a great place for people to invest. And why is that the case? Well, when we look at the age profile of an individual, as investors are young, they can bear more risk and more volatility in their portfolio. And this chart shows how these target date funds dynamically change your portfolio allocation as you age and approach retirement and beyond. And as you're young, they allocate about 90% of your portfolio to stocks across US and international equities. As you start retirement, it draws that down to about 50% allocation to stocks. And then as you hit the age of 72, that percentage goes down to about 30% exposure to stocks. So literally the only decision you would ever have to make in your investing career with respect to these target date funds is choose the single fund that corresponds roughly to your retirement date. So if I want to retire in 2065, I would choose the corresponding Vanguard Target 2065 fund and put all of my money for the rest of my working career into that. And in fact, I would continue to withdraw from that same fund through retirement. And technically, once you hit retirement, it transitions to something called a target. It's a Vanguard retirement income fund. So it drops the date, but the idea is the same, and you'd be in the region to the right here. Next slide. And I guess after staring at this streamlined menu, you might naturally be asking yourself, well, why are there so few fund choices? I think we're taught from a young age that it's prudent to diversify. And you might think, well, with so few tickers, how can we possibly diversify? Well, it turns out that each of these funds that we've selected offer an incredible amount of diversification. For example, these target date funds hold over 10,000 stocks across the US and internationally, and over 15,000 bonds across the US and abroad. Similarly, the total US stock fund holds over 4,000 individual stocks, weighted proportional to their market cap. Same is true for the total international stock fund, which owns about 8,000 international securities, as well as the total bond fund holds over 10,000 US bonds across government bonds and corporate bonds. So again, even though that this streamlined menu is quite streamlined or quite simple, don't be fooled, because there's a whole lot of thought and deliberate planning that went into these decisions. Next slide. And I guess the next topic that is awfully important is the topic of fees. And each of these funds were selected for their low fee structure. And as Bruce alluded to, our plan is quite large in terms of participant count as well as plan assets. And the really interesting thing is that with those billions of assets, we can negotiate lower fees with Vanguard, and that's exactly what we've done. And to give you an idea for how low these fees are for the target date funds, we've negotiated those fees down to 4.5 basis points or 0.045%. To give you an idea for how big or small that number is, our current funds charge about 10 times that for the corresponding target date fund. And you might not be impressed by that, but I'll show you on the next slide that these fees can add up in pretty dramatic ways. I guess, what else do I have to say on this slide? The index funds that we're offering, even though they're owning thousands of individual stocks, they're charging us very little in fees. For example, the total stock market index is charging only 1.4 basis points, 0.014%. And as an investor, that is great news for us because we are going to receive more of the returns and pay less in fees as a result. So when this committee is talking about $11 million in savings to employees and retirees, sorry, this table is how those savings are generated and how you as an investor will, your accounts will be bigger as a result. Another important distinction in this table is that this first column here, there's an acronym CIT that stands for Collective Investment Trust. Basically, there's some archaic legislation that prevents 403B funds or 403B monies from being held in these collective investment trusts. Our consultant Cap Trust as well as Vanguard are assuring us that legislation is hopefully on the horizon, maybe within the next year, where that will be rectified and we'll be able to enjoy these lower fee structure within the 401A and 457. But for the time being, we'll be paying a fraction of a percent more in fees for funds held in the 403B. But please be assured that we are doing our best to, when that opportunity arises to lower the fees even further for that 403B, we will exploit and take advantage of that opportunity. Next slide. All right, again, if you haven't done the math before or sat through one of my finance classes, you might be surprised to see how big of an effect that this measly 0.45% per year in investment fees, how big of a difference that can make to an investor over their investing horizon. And of course, in a single year, the amount of savings isn't particularly impressive. But when those savings are compounded over a 35-year investing career as one is working, and then a 30-year drawdown in retirement potentially, that's 65 years for that 0.45% per year fee to ravage the returns basically of an investor. On the left side, we see kind of a simulation for how this might look if we assume a 6% return and $10,000 a year of contributions. We see that the investor who is investing in lower cost funds will end up with a retirement balance roughly $100,000 more than the investor investing in high cost funds. And you might say, well, Brian, I'm already retired. How do fees matter for the retiree? We could do the same simulation in reverse. Say we start at $1 million and we plan on withdrawing $70,000 a year for a retirement, for a 30-year retirement. And we see that the low fee scenario ends with $250,000 more than the high fee scenario. Of course, if we were to combine these two charts into one, it would be even more pronounced. So again, fees matter, especially when compounded over many decades. Next slide. And if you look at our menu, you'll note that each of the funds that we offer are index funds. And you might not be familiar with that term, but it's a special type of mutual fund that offers broad diversification, as we saw, and offers extremely low costs, which we also saw in the previous slides. And because of these lower costs, we find out that on average, they offer higher returns relative to actively managed mutual funds. For example, in the bottom left chart, we see that over the past 10 years, from 2011 to 2021, that 82.5% of mutual funds have underperformed their passive benchmark. And this finding has been replicated ad nauseum in the academic literature. And here we have Ken French at Dartmouth writing a paper on the topic in 2008, I believe. The last paragraph in this abstract says, under reasonable assumptions, the typical investor could or would increase his average annual return by 67 basis points or 0.67% per year over the 1980 to 2006 period if he switched to a passive or indexed market portfolio. So again, academics have been harping on this for quite some time. It is an incredibly robust finding, and we're leveraging this fact as well as other institutions like Stanford and Harvard and so on to bring the best of the academic knowledge to benefit our employees. Next slide. And it's just not academics that are aware of the benefits of low-cost investing, but also practitioners, the most famous of which is Warren Buffett, who has been telling investors as long as I've been listening and reading his material to invest passively in low-cost funds. And the logic is incredibly sound, right? And he's advocating that we keep, as investors, our costs as low as possible. And he's in the very concluding paragraph here. We don't have time to read it all, but I invite you to do that offline. He says that he's putting his money where his mouth is. So in his will, when he dies, all of his assets will be transitioned to a very low-cost investing portfolio. I guess I'll read the part in bold. 10% of his wealth will transition to short-term government bonds, and 90% will be transitioned to a very low-cost S&P index fund. I suggest Vanguard's. He believes the trust long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. So what do I want you to take away from this slide is that savvy individuals are mindful of the debilitating effect of fees when compounded over a lifetime. How do you avoid them? By investing passively in low-cost index funds. Next slide. And you might note that Vanguard was mentioned specifically by Warren Buffett in that letter to shareholders. And so why is Warren Buffett recommending Vanguard funds? Why is this committee recommending the adoption of Vanguard funds? It's because they are well regarded. They have a track record of operational excellence. They have low cost fees. And yeah, they're the real deal. They now have about $7 trillion in assets. Next slide, please. And with that, I will pass the time over to Joey, who is our consultant from CapTrust, and he will talk about the process by which our existing menu will now transition to this new plan. Thank you.
Yeah, thank you, Dr. Bob. So you currently have monies invested in various annuities and mutual funds. And so when we initiate the transition to the new investment menu, there's a process that we will follow called mapping. And this is how we get your existing assets to the new investment menu. And how that happens depends on what type of investments that you have. So what we're proposing is on November 1st, all future contributions will be directed to the age appropriate target date fund. So we're going to default you to the target date fund that corresponds with the date that you will turn age 65, the fund that is closest to that, whether that's the 2040, 2050, et cetera. And right about that time, all the assets that you have that are mappable, which is typically the mutual funds at TIAA and all the mutual funds at Fidelity, except for the 403B funds. They're in a special individually controlled investment contracts that do not allow the institution to map those assets over, but individuals certainly have the ability to do that on their own. So employees are going to have time. Somewhere around the 1st of September, there's going to be a 2-month window where the new investments are in the menu, the brokerage accounts are live, and individuals can move their investments either to the new core investment menu, the new target date funds if you want, or to brokerage. And you have the ability to work with Fidelity to do some in-kind type of transfers over to the brokerage window for those people who are savvy investors and want to go down that path. We expect that the vast majority of individuals will just keep their monies where they are invested in the target date funds as we go forward. And can we, I'm not seeing the bottom of this slide. I don't know if we can raise that up a little bit. So the assets that you have at TIAA that are in annuities are not mappable. And I think, can we go to the next slide? I think we covered that on the next slide. So the TIAA annuities, the funds that you have there will remain exactly where they are, except for your future contributions will be mapped to the target date fund. So even though you're not adding any new money to the TIAA annuities, you do have the ability to continue to transfer monies among those annuities. So you're going to have what we call your old investment contract that contain those annuities. So if you want to move money from, say, CREF stock to TI traditional, you have the ability to do that. Or if you want to move the monies to the new investment menu, you have the ability to do that as well. Only individuals can do that due to the nature of the contracts. So we talked about the investment choices, and I think Dr. Ball mentioned that you have the annuity or the brokerage window for those people that want to continue to invest. Basically, any mutual fund that you have access to today, you will have access through the brokerage window. Next slide, please. So I think I got ahead of myself a little bit. So here's the list of the CREF funds that are not being mapped, and these are all annuity products. And as I said earlier, the Fidelity 403B funds are in individually controlled contracts. So those will not be mapped as well. Next slide, please. And I think we've basically covered the first part of this. So the last bullet, I want to say that, you know, there was a lot of discussion around which funds to keep in the core menu. And the TIAA traditional fund was decided to keep that fund in the menu. But the other annuities, you know, looking at the cost and what individuals can get through the new core menu, the committee decided that those products didn't fit. However, the good news is anybody that is really interested in maintaining those will be able to keep their balances in the current annuities. You just won't be able to add to it as you go forward. Next slide, please. So you have, I mentioned TIAA traditional earlier, you have that already in what is called your RA or GRA investment contract. And, for people that are trying to move their money out of those, the traditional annuity to another investment, you're locked in. It takes 9 years, 10 installments over 9 years to actually move your money to another investment. And you can see it has a 3% minimum crediting rate. The new contract, which is called the TIAA RC contract, it has a shorter transfer period. You can actually transfer your money over 7 years to another investment. It has a 1% minimum crediting rate, but it actually credits the overall current crediting rate is actually higher. And yesterday, I was aware that TIA has actually increased both of these fees by 1% or 100 basis points. So the new account is currently crediting at 4.5%. The one thing we want to make sure that you understand, the last bullet here, is if those people interested in a lifetime annuity option, you can get that through this new contract as well as your existing TIA traditional annuity. So no change in the lifetime income option. Next slide, please. And so here's just an example of the crediting rate. And the crediting rate is actually higher on the new contract, the RC, which is listed below. And the reason is it has a lower minimum crediting rate, which means that TIAA, because the minimum crediting rate is lower, then they have to have less reserves set aside to meet that minimum, and they can actually invest more of the money into assets that generate income. And so you're able to actually, over time, as you see here, get a higher return for that difference in the contract. So all your previous TIA contributions will stay in your existing account today. Only new contributions will go into this new TIA traditional in the RC contract. Next slide, please. And I think at this point, I'll kick it back to Bruce to finish up our presentation.
Thanks, Joey. This is a timetable on when these changes will occur. As has been said in this presentation, right now, you don't really need to do anything. This is a draft plan. We're collecting your thoughts. So if you have questions or concerns, we're going to give you this email address to email those to. Sometime in August, we'll come back with some more detailed explanation of when this time opens up for you to make these changes, which will generally be in September, October with the November go live date. I think an important thing to remember is that we've talked about funds being mapped, but even after November 1st, you will still be able to make changes, just as though you can make changes now. So it's not a drop dead. You can't make any changes after that November 1st date. So if you're hesitant to make any changes in that September, October date, you want to just wait for a bit, that's going to be fine too. Next slide, please. So one question that we have received in the past is, what about retirees or separate employees? And it's important to know that retirees and separate employees really have the same enhancement options as active employees. Everything that we've talked about here in this presentation will apply to them too. Next slide, please. So if you have questions or you have comments, we would love to hear those anytime, but anything that you send in before March 31st, we're going to have the committee review before we make any final recommendations. Email at benefits@nebraska.edu. Now I'd like to turn it maybe back over to Brian Schlichting to see if we have any questions that we could address or that Brian wanted to talk about. Brian?
Thanks, Bruce. Yeah, we've had several great questions that have come back via the online Q&A form here, and many of our panelists here have been answering those questions back to you. So hopefully you've all gotten responses here, but there has been a couple themes now, and please do continue to ask questions on that thing here. We'll keep this open for the next few minutes, as long as questions are being asked, or till 60 minutes. So I guess just one general housekeeping item, a question that's been asked here has been regarding recording and accessing this presentation later on down the road. We are recording this presentation. We also recorded the presentation from last week as well, and we'll place that on our benefits website. So probably the easiest way to get there is either click on that link in the email you received with this original announcement, or if you go to nebraska.edu/benefits and then click on the retirement section, this information will be linked there as well. So again, it's also got some FAQs on there, initial announcement email, copies of these slides from today as well. So, and then recordings of these presentations. So that information will be out there for you, available for you. I guess just some overall themes that I'm seeing in the questions, and there's still some questions going in here. So if any of the panelists want to raise other items for consideration, or just to talk about, please feel free to interject. But I guess one theme I saw in the questions as we were going along is, how do I find out which company my retirement is going to? Is it going to Vanguard or TIA? And actually, it's still going to stay the same as where it is today. It's going to go to either TIA or Fidelity originally, but these Vanguard investment options will be housed on the TIA and Fidelity platforms. So you'll never actually have a direct interaction with Vanguard. The interaction will be with Fidelity and TIA still. And the Fidelity and TIA reps will be able to assist you in this process. So that's who you'll reach out to if you're working with one today. If not, you can call Fidelity and TIA and work with one of their reps there. But those are the main reps you'll work. Also, you've got the campus benefit offices that'll be able to assist in this process as well. Go ahead, Brian.
Yeah, I'll take a question, and I'm sensing a common thread here, which is that this presentation went a little fast, and it's just, there is a lot of information, so I am sympathetic to that, and yeah, we definitely hear you there. So one question is just saying, look, can you exactly explain, like, slowly and clearly, how this transition is going to work going forward? And let's just take kind of a baseline scenario. Let's say that someone is with Fidelity currently, and they have $300,000 invested in their retirement plans. And for illustration purposes, let's say that $100,000 is in the 401A, 457, 403B. Okay, 100,000 times 3 gets us to 300,000. So come September, October, we're going to open up this window where people can opt out of these default changes. And so let's think about what the default changes are going to be. So for this individual with 300,000 in Fidelity, the default is to map all of these mappable assets into the age-appropriate target date fund. And due to a weird quirk, the Fidelity 403B is not mappable. Okay, so what does that mean in practice? That means that the 401A with $100,000 in whatever funds, it will be mapped to the new menu for that 100,000 in the corresponding age-appropriate target date fund. The same thing would be true for the Fidelity 457. And due to this weird quirk, and believe us, we were not, we tried to solve this, but Fidelity was a bit stubborn. Fidelity would not budge and help us map the Fidelity 403B to the new menu. So what does that mean? So this particular individual with 100,000 in a Fidelity 403B, whatever your current allocation is, it'll stay put so that those funds won't be mapped to the new menu. However, you can, with a couple of mouse clicks, easily benefit from this new menu. You'll just have to opt into that manually. So again, what's the distinction? Most of those, 200,000 of the 300,000 will be mapped to the age appropriate target date fund. And then the remaining 100,000, you just click a couple times. And I think a follow-on question, okay, and just to kind of continue to expand on that example, if someone doesn't like these target date funds, and that's fine, they're the default option because we think they're most appropriate for most people. But if you have expertise that tells you otherwise, that's great. During that 2-month window, you'd be able to opt out. In fact, even past that window, you'd be able to undo the changes that we would make for you, or that mapping process. So I hope that was helpful to you who asked that question. It's a really good one. But I guess what's the other thing that we would, like, what's the last remaining thing that I could add on that example? Is it all new monies, starting on your November paycheck and beyond? The new contributions would then default to the target date funds that is age appropriate for your age. And again, if you want to opt out of that, you're more than welcome to over that 2-month window, or even beyond. If let's say you forget to opt out of the contributions, your November paycheck is going to hit a target date fund. And then you say, oh, I didn't want that. And in December, you could say, well, now I want to invest in an international stock fund instead. And you can do that in December and beyond, and then even change your existing money that hit that paycheck. So anyway, I hope that was clear. And I hope that people are, assured that these changes are really intended to be in the best fit to benefit the most amount of people, right? By having these defaults be prudently selected.
Thank you, Brian. Just a couple other comments, questions here as they continue to come up here. One says, will you send out detailed directions closer to November 1st on this process? Absolutely. I think the plan as of today is that we will get something out to you in the August timeframe that has, a specific timeframe, detailed directions. So we should have more detail in that time. And that's really when the action will start commencing for our employees and retirees as well. So more information to come. We'll provide more details down the road, and I would expect that to be in August. I think I saw another quick question here that popped up. Is the Vanguard funds available prior to November 1st? Unfortunately, the answer is no. It's going to take us some lead time on the implementation to get those available, but they'll be available starting November 1st. Is there any other questions, comments? I know a few of our panelists have been answering questions, so they pop up off my screen here. I saw another one that was, it seemed to pop up a couple times, is that using the target date funds that I'm going to turn age 65 in, can I adjust that if I plan to retire either earlier or later? And the answer is yes, absolutely. The ideal time would be in that September, October enrollment period, but you're not limited to that as well. So you can make changes beyond that as well. So, but yes, you can make adjustments to that target date fund.
I see a familiar face, Mark from last time is asking a good question here about the brokerage funds. He's asking whether those list of mutual funds will be available before, before we go live. We do have that list of funds, so yeah, we can chat with Brian here and try to make that available. But it's literally on the order of 8,000 funds that will be available within the brokerage window, beginning in November. So we believe our employees will be quite happy with that.
Yeah, absolutely. We'll get that list out to you prior to when this process completes. So it might not be tomorrow or anything like that or next week, but we will get that out to you ahead of time. Joey, there's another question on here that I think is really excellent. We've gotten this a few times via email too, is talk about the TIA traditional annuity, if you would, just for a few moments, maybe revisit that subject. And if I've accumulated a balance in there over my last 20, 30 working years, how will these changes impact my TIA traditional annuity investments? Can maybe you address it for us?
Yeah, thanks. I was in the process of answering somebody's question. Somebody had said, if I plan on retiring in the next few years and doing that with and taking a TIA annuity for the rest of my life, how will this be impacted? And the answer is you're not impacted. If you're close to retirement and you have money in these TIA annuities, the balances are going to stay right where they are. Only contributions going forward after November 1st will go into the new investment menu. And you can work with TIAA individually as it relates to your asset allocation and decide, where those new monies should go as you compare that to where you already have money invested in your existing contract. So you should not be impacted by that. If you work with TIA, you should be able to balance between the new contract and the old contract. The annuities, most people that are taking lifetime income tend to take that from the fixed account, TIA traditional. And so there's a new version of TIA traditional, very similar. And so if you're investing in that in the new contract, then you'll basically get two checks from TIA, one from the old contract, one from the new contract. If you're one of the reasons why we didn't include the CREF variable annuities in the new contract is most people that are, like I said earlier, are not taking lifetime income from those annuities. And so they tend to just be very similar to mutual fund investments. And frankly, you can get mutual fund investments either through the core menu or the brokerage window at a lower cost. So those people that have, saved through TIA and invested in those annuities over time, your balances are going to stay there. You're not really impacted by that. It's just going forward, your money will be in the mutual funds, and you can work directly with TIAA to determine, how you should be invested in the new investment contract, considering how you're already investment with the annuities in your old contract. And you can harmonize your investments between the two so that makes sense for you.
Thank you very much, Joey. One other question I think we got a couple times today, and I've gotten a few times via email as well, is along the lines of, hey, I like my existing, investment allocations today. Is there any way that I could just keep those going forward without having to go through this process? So I don't know if anybody cares to answer, or if not, I can, yeah, okay. I'll put together an answer here is, and unfortunately, or I shouldn't say unfortunately, yes, you will have to go through this process. That's why we've kind of tried to create the 60-day window there of September and October to go through this, as many of the funds, as you are aware of after today's presentation, are not going to be available on our future menu, or if they are, they're going to be in that the brokerage window. So you'll have to register with the brokerage account, even though it's housed in the 401A, 403 in our retirement plan. So yes, everybody's going to have to go through that process if they want to continue their current allocations or something similar.
And maybe CapTrust can help here. Mark asked another question, is with the existing assets in a 403B at Fidelity that we've already advertised are not going to be mapped. If Mark wants to stay invested in the current funds, he doesn't do anything, right? There's no, because by default, the Fidelity 403B funds and investments will stay as is. Is that right, CapTrust?
That's correct. Yes.
Yeah, that's correct.
Yes.
That's correct. The brokerage window will be in the new investment lineup. But somebody that's in the Fidelity 403B would have access to their current investments as they are today. But that's only for existing balances. Any new balance contributions that they make in 403B will go to the new investment menu.
Thank you, Joey. Somebody asked just I think kind of a follow-up question to that, again, to the mapping process. It's about mapping balances going forward. So if you are, well, maybe Joey just, or Jim or somebody else, if we can revisit that discussion just a little bit more.
Are you trying to address this question here? Because this question has come up a few times.
Okay,
They
go,
say,
yeah,
well,
go ahead. Yeah.
I guess
elaborate.
an open question right now, sorry, Brian, is if you plan on retiring at the age of 70, how might you select a target date fund? You're right. So then it probably makes sense for you to choose the date corresponding to when you're 70 years old, not 65. So I don't know if Cap Trust, they want to add to that answer, but
Sure.
But yeah, you're right that when we do map, the mapping process will assume a retirement date at the age of 65. But if you do want to retire at 70 or 75 or whatever, you can. Oh yeah, that's a great. Thanks for pulling up this slide here. This to answer that question. This is how your investments are allocated according to your age, and so if you want something that is more conservative, so there is nothing preventing me as a relatively younger guy, of course I'm being a little bit generous there, but there's nothing preventing me from selecting a 2020 target retirement fund or a 2025 target retirement fund if I'm feeling very risk averse and I want a portfolio allocation that is a higher allocation to bonds and fixed income than stocks. So yeah, this is, you're right that we or Fidelity and TIA through this process is going to look at your birth date, right? They have that information. They're going to use when you turn 65 as a proxy for your retirement date, and then they'll choose the fund accordingly. But if we do look at this chart, you can see that the asset allocation is relatively stable, plus or minus a few years there. So, if you don't tweak that allocation, it's not going to be the end of the world because the allocation is pretty similar across those age cohorts there.
Yeah, I would just add, this chart is used to just show you at your age how the assets are invested. The actual investments have 5-year age bands. So a 2040 fund, for example, there's 2040, 2045, 2050, et cetera. So that's where you're looking at what date you might consider retiring. So if you're 45 years old today, then in 20 years, you'll be 65. So we had 20 years to 2022. That gets us to 2042. Well, the fund is either 2040 or 2045. So you arbitrarily, depending on exactly what your birth date is in this mapping process, we're going to put you in that example, probably in the 2040 fund. But if you're like, well, I know I'm going to work longer and, I'm more comfortable just moving that to the 2045 fund, yeah, sure, you have the ability to do that. It's up to you. And we would encourage people to, ask questions to TIA and Fidelity along the way.
Thanks, Joey. I think it looks like the questions have kind of slowed down here. So I'll just throw it out there if there's any concluding remarks or questions here. Looks like
Yeah, it looks like one more question rolled in here. Is the mapping of funds based on the existing allocation you already have or your actual age? The answer is actual age. So if you are let's say you're a 40-year-old, but you are very risk averse and have correspondingly developed a very risk averse portfolio allocation currently, then this mapping process will map you into something that is age appropriate with, let's say if a 40-year-old will be mapped to a target 2065 fund, for example. So again, if you don't like that suggestion of that mapping, you're more than welcome to opt out of it. It looks like Jim is going to take an attempt at solving that as well. So, all right, with that, yeah, Brian maybe asked me to kind of draw this down, but so I guess what is it that we hope to have accomplished in this meeting and last is to hopefully give you some assurance and confidence that that there was a lot of thought and deliberation and and thoughtfulness that went into these decisions. And I can assure you that every decision that was made was for had the participants' best interests at heart. This isn't self-serving at all. And we truly believe that by lowering the fees and the costs of running the plan, you as the plan participant will be much better off. And I know this can be overwhelming if you haven't heard these terms before. I'm sure it's like we're speaking German, but rest assured that in the coming months, especially as we transition to fall, you will see very explicit communication on any steps that you need to take advantage of this new menu. But I guess, what are the actionable things for you today? At a high level, what I think is going to be true going forward, right? Assuming that, that this plan goes forward, is that there is going to be an incentive to consolidate to a single record keeper going forward. And this process, can take a few weeks. And there's no urgency here, but in the coming months, you have about, what is it? So we're in March now, and this transition is about 8 months away. So sometime between now and 8 months from now, you probably want to think about consolidating your existing assets and contributions to a single vendor going forward, just to save you $30 a year. Again, if you don't want to do that for whatever reason or forget to, it's going to be $30 extra a year of fees, and it's not the end of the world. And then if you're kind of on the fence, let's say you have half your assets at TIA, half your assets at Fidelity, and you're kind of uncertain as to which vendor to select going forward. I mean, here's a basic rule of thumb that I think is quite handy, is if you plan on utilizing the TIA traditional annuity, then of course it makes sense to go to TIA. And if not, then it probably makes sense to go to Fidelity for a couple of reasons. The most important of which, is that you're saving about $9 a year in record keeping expenses going forward. But given the harmonized menu and so on, we're going to be, it could be as simple as a coin flip for most people. So anyway, I think that's about what I had to say here. So please be assured that we've done our best to do a good job for you. And I'm confident we've done that, and hopefully you have confidence that is the case as well. So thank you. And I don't know if any more questions have rolled in, but thanks.
Nope. It looks like we're at the kind of top of the hour here. So want to just finally, I guess, conclude by thanking all our panelists for being here today. And thank you for attending, taking time out of your busy schedules to attend this and ask some great questions and provide some feedback. As you think about this or have other questions, feel free to reach out. Know that we're available to assist. Email the benefits@nebraska.edu email address. Many of the panelists that were here today are the ones that respond to those questions directly. And also in the future, Fidelity and TIA representatives are going to be available to help assist you with this process as well. So I know it could seem overwhelming for some of you, but we're here to help. We'll be available going forward. So again, thank you for all you do for the University of Nebraska. Thank you for all your time, and we will be in touch. So thank you and have a great day.